Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today I will be talking about a stock that I came across while going through the Japan Company Handbook, and that stock is called Nitto Denko. Nitto Denko is a comprehensive material manufacturer that covers a wide range of products including adhesive tapes and surface protective films for automotive and industrial products. It also provides semiconductor sealing materials, electronic components related materials such as FPCs for HDDs, polarizing plates for liquid crystal display TVs and monitors, engineering plastics and polymer separation membranes. The company also manufactures medical related materials. The company's basic strategy is to establish a global niche top position, which means to create niche markets through proposal-based sales and to leverage its high functional materials to come out being a leader of such markets. Nitto Denko has 4 operating segments. The first one is its industrial tape segment, which brought in about 40% of the company's consolidated sales in 2020. The second segment is its optronics segment, which brought in about 54% of the company's consolidated sales. The third one is its life sciences segment, which brought in about 3% of the company's consolidated sales. And the fourth segment is its other segment, which brought in about 3% of the company's consolidated sales. Nitto Denko's overseas sales ratio is about 74%. What this means is every $100 that the company made in the year 2020, about $74 out of those $100 came from sales outside of Japan. Now that we have a brief understanding of Nitto Denko's business products and its business segments, let's review the company's fundamentals by focusing on its key ratios and find the intrinsic value of the company by performing the discounted free cash flow DCF analysis. So let's dive in and review Nitto Denko. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at Nitto Denko. Under key ratios, I have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company brought in about 607 billion yen. And for the year 2021, it brought in about 761 billion yen. We can see that the company's revenue over the past 10 years has been stable, and there hasn't been any major fluctuations in its revenue. Next, looking at the operating income. The operating income is what's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about 56 billion yen, and for the year 2021, it was about 93.8 billion yen. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about 31 billion yen, and for the year 2021, it was about 70 billion yen. The net income over the past 10 years has a similar trend as the company's operating income. We do see that the company's net income has always been positive, which tells us that every year for the past 10 years, the company has reported a profit. After that, looking at the dividends per share, back in 2012, the company paid out about 24.69 yen per share as dividend, and for the year 2021, it paid out about 100.76 yen per share as dividend. Over the past 10 years, the company's dividends per share has been trending upwards. Ever since 2017, the company has been hiking its dividends. That is something that we want to see as shareholders, as that is a means for us to regain our capital that we have invested in the company. Next, looking at the shares outstanding. Back in 2012, the company had 329 million shares outstanding, and for the trailing 12 months, it had 296 million shares outstanding. Over the past 10 years, the company's shares outstanding number stayed fairly consistent from 2012 all the way through 2016. And ever since 2018, the company's shares outstanding number has been decreasing. That tells us that the company has been buying back its shares, which actually helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2012, the company's book value was about $14.74 per share. And for the trailing 12 months, it's about $22.36 per share. Over the past 10 years, the company's book value per share has always been positive. That tells us that the company's assets always exceeded the company's liabilities, and the company's book value per share is trending upwards, which tells us that the proportion of the company's assets to its liabilities is increasing. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the capital spending from the company's operating cash flow. Back in 2012, the company's free cash flow was about 58.5 billion yen, and for the trailing 12 months, it's about 71.7 billion yen. Ideally, we want to see the company's free cash flow to be positive, staying steady or increasing. And we can see that the company's free cash flow over the past 10 years have been positive, which tells us that the company's operating cash flow always exceeded its capital spending. And over the past few years, ever since 2019, the company's free cash flow has slowly been trending upwards. Lastly, I will be using the trailing 12-month figure of 71,659,000,000 yen free cash flow number for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012, the company's net margin was 5.11%, and for the year 2021, it was about 9.23%. What this means is every $100 that the company made in the year 2021, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $9.23 left as pure profit. Ideally, we want the company's net margin to be positive, staying steady or increasing, and we can see that over the past few years, the company's net margin has been in the high single-digit range. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2012, the company's return on equity was about 7.28%, and for the year 2021, it was about 10%. When we look at the past 10-year trend, we can see that there were only 2 years when the company's return on equity was less than 8%. That was back in 2012 and 2020. So out of the past 10 years, there were 8 years when the company's return on equity was greater than 8%. Next, looking at the return on invested capital. The return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2012, the company's return on invested capital was about 6.43%, and for the trailing 12 months, it's about 11.47%. Nitto Denko's weighted average cost of capital, also known as the company's hurdle rate, is about 5.67%. And since the company's return on invested capital is greater than the company's weighted average cost of capital, we can safely say that the company's management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. Benjamin Graham, the father of value investing, preferred to only invest in securities that had interest coverage of 5 times or higher. Back in 2012, Nitto Denko's interest coverage was about 55.96 times, and for the trailing 12 months, it's about 110.68 times. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0. It's even better if it's greater than 1.5. A current ratio greater than 1.0 tells us that the company has enough current assets to fulfill its current liabilities. Back in 2012, the company's current ratio was about 3.05, and for the latest quarter, it's about 3.36. Over the past 10 years, the company's current ratio has always been greater than 1.5. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want the company's quick ratio to be greater than 1.0, as that tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was about 2.43. And for the latest quarter, it's about 2.61. Over the past 10 years, the company's quick ratio has always been greater than 1.0. So both the current and quick ratios indicate that the company is very liquid and was never in a liquidity bind. Finally, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A high financial leverage ratio tells us that more of the company's assets are financed via liabilities. Back in 2012, the company's financial leverage was at 1.5, and for the latest quarter, it's about 1.34. Ideally, we wanted the company's financial leverage to be staying steady or decreasing, and we can see that over the past 10 years, the company's financial leverage has slowly been trending downwards. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes its sale to the day it actually receives cash for that service rendered. Back in 2012, the company's days sales outstanding was about 78 days, and for the year 2021, it was about 80 days. Ideally, we wanted the company's days sales outstanding number to be staying steady, and we can see that over the past 10 years, the company's days sales outstanding number has stayed fairly consistent. What we do not want to see is a company whose days sales outstanding number is growing rapidly, as that means that the company is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can report an inflated income number on its income statement. However, we can see that Nitto Denko is not playing such accounting tricks, as its days sales outstanding number has been consistent. Next, looking at the days inventory. This number gives an idea of how many days does Nitto Denko's products sit in its inventory before they're sold. Back in 2012, the company's products sat in its inventory for about 54 days. And for the year 2021, the product sat in its inventory for about 72 days. What this means is the company is less efficient at going through its inventory now than it was 10 years ago. After that, looking at the payables period. This number gives an idea of how many days does Nitto Denko take to pay its suppliers. Back in 2012, the company's payables period was about 89 days, and for the year 2021, it's about 68 days. Ideally, we want to see the company's payables period to be staying steady or decreasing. We can see that over the past few years, the company's payables period has stayed consistent. What we do not want to see is a company whose payables period is growing rapidly, as that means that the company is trying to artificially inflate its cash flow numbers by holding on to its cash. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Nitto Denko has a PE of 16, whereas S&P 500 is at 25.3. Nitto Denko's price to book is at 1.7, whereas S&P 500 is at 4.5. The company's price to sales is at 1.6, whereas S&P 500 is at 3.2. The company's price to cash flow is at 10, whereas S&P 500 is at 18.1. And finally, the dividend yield. The company has a dividend yield of 2.4%, whereas S&P 500 is at 1.4%. So we can see that on all these valuation metrics, Nitto Denko is undervalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Nitto Denko. Over here, I pasted the company's trailing 12-month free cash flow number that I got from Morningstar, which was actually 71,659 million yen. I divided this number by 110 as the current conversion rate of $1 is equal to about 110 Japanese yen. So the US dollar equivalence of the free cash flow was about $651 million. I'm assuming that the company's free cash flow will grow at 7% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I expect this investment to give me a 10% return. I'm using a long-term growth rate of free cash flow to be 3%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 3%. The company has 269 million shares outstanding and has other long-term liabilities of $176 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $42.3 per share. And when we compare this intrinsic value to the company's current stock price, we can see that the current stock is trading about 8% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $5.6 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $12.7 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $42.3 per share. Now, if we add the book value per share to this intrinsic value number, we get that amount to be about $64.62 per share. Now, if we disregard the perpetuity component from the intrinsic value number, in other words, if we think that Nitto Denko is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $18 per share. And if we disregard the debt, in other words, if we think that Nitto Denko is going to grow into perpetuity, so there's no point for the company to worry about its debt or long-term liabilities, then we get the intrinsic value without the debt to be about $42.85 per share. Finally, we know that the company's weighted average cost of capital, also known as the company's hurdle rate, is about 5.7%. And if we add a 3% margin of safety on top of that and make our discount rate 8.7%, then we get the intrinsic value to be about $53 per share. And when we compare this intrinsic value to the current stock price, we can see that the current stock is trading about 26% below the company's intrinsic value. Hey guys, that is all I had for you this week. We saw that Nitto Denko has strong fundamentals and is an undervalued security. Just a reminder that Nitto Denko's intrinsic value is also governed by the currency exchange rate. So when the US dollar is strong, the company will have a lower intrinsic value. And when the US dollar is weaker, the company will have a higher intrinsic value. Hopefully you found this video interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.